In this video we are going to talk about 12 dividend aristocrats. So before starting, please like this video and subscribe to this channel for our future updates. There are 65 dividend stocks in the S&P 500 that have increased their cash payments for at least 25 years. These corporations have increased dividends in both good and bad times, including the COVID-19 pandemic and the Great Recession. Here are 12 great dividend aristocrats currently on sale. It was important to find stocks that were trading considerably below their 5-year average P/E or price-to-cash flow multiples. The former tells you how much investors are prepared to pay for each dollar of reported profits, while the latter compares a stock's price to its operating cash flow per share. Number 12. Atmos Energy. The nation's largest gas provider, Atmos Energy, Auto, $90.16. The corporation serves over 3 million people in 8 southern states. About 72,000 miles of Atmos Energy distribution and transmission pipelines connect the major Texas shale gas fields to major market centers. Because the company's earnings are 100% controlled and rate-based, EPS is predictable. Through 2025, Atmos Energy expects to raise its EPS by 6 to 8% annually, aided by rate base expansion and $11 to $12 billion in capital expenditures to expand and modernize its collection and distribution infrastructure. With a high debt load, Atmos Energy is typical of most utility firms, but with lower interest rates and more manageable near-term debt maturities. Moody's and Standard & Poor's have given Auto investment-grade credit ratings. Number 11. Stanley Black & Decker. Stanley Black & Decker, SWK, $176.83, is a global leader in power tools, lawn and garden equipment, and industrial products and services. Popular names include Stanley, Black & Decker, DeWalt, and Lennox. Power tools account for 71% of 2020's total revenues of $14.5 billion. Over the last 5 years, the company has raised revenues by 5%, adjusted EPS by 9%, and free cash flow by 111%. These goals will be met through expanding its electronic security and engineered fastener businesses, as well as through acquisitions. SWK has acquired almost $11 billion in assets since 2005. In 2021, the company expects organic revenue growth of 16 to 18% and EPS growth of 26 to 29%. Number 10. Abbvie. Abbvie, $109.32, is well known for its arthritis medicine, Humira. It also owns popular immunology drugs Skyrizi and Rinvoq, oncology drugs Imbruvica and Venclexta, and neurology drugs Botox and Vraylar. While some investors think the company's results may suffer after Humira's patent expires in 2023, Abbvie has been developing its new medicine pipeline through R&D and acquisitions. The company expects sales to fall in 2023, then recover somewhat in 2024 and 2030. A $15 billion peak in Skyrizi and Rinvoq sales is projected in 2025. Its cancer medication brand, worth $6.6 billion, will continue to grow for a decade, while Abbvie's migraine therapy portfolio tackles a $3 billion market that will increase to $9 billion by 2025. Number 9. Cardinal Health. Cardinal Health, CAH, $48.66, is a significant manufacturer and distributor of medical and laboratory supplies. Globally, the corporation earns about $162 billion in annual revenue. Cardinal Health has had barely 6% annual top-line growth in drug distribution over the last 5 years. By restructuring its medical business and paying down debt, the company intends to enhance profitability and pay down debt. Cardinal Health sold its Cordis medical device company for $1 billion in August and is focusing on markets where it has a competitive edge. Number 8. Walgreens Boots Alliance. Walgreens Boots Alliance, WBA, $46.11, is the world's largest retail pharmacy business. Outside of the United States, the firm has approximately 4,200 pharmacies operating under the Boots brand in the United Kingdom, Thailand, and the Middle East, Benavides in Mexico, and Ahumada in Chile. With equity interests, Walgreens has 21,000 shops in 25 countries. The pandemic hampered last year's statistics, but Walgreens' fiscal third quarter concluded May 31st with sales up 13% year-on-year. Plus, adjusted earnings per share increased 81% over the last 3 months, and free cash flow increased 36% to $3.3 billion. Number 7. 3M. 3M MMM $178.40 is a dividend king with 63 years of dividend increases. 3M is best known for its Scotch tape and Post-it notes. However, it also manufactures wound care products, structural adhesives and abrasives, protective films and connectors for transportation and electronics, and home cleaning and painting accessories for the consumer market. 3M began restructuring in 2020, with the goal of reducing annual operational costs by $250 to $300 million and paying down debt. The pandemic lowered adjusted EPS and flattened sales in 2020, but 3M remained resilient, increasing free cash flow by 23% to $6.6 billion and achieving a 123% conversion rate. All 4 MMM business segments are growing organically in 2021. In the June quarter, total revenues increased 25% and adjusted EPS increased 44%. Number 6. Archer Daniels Midland. Archer Daniels Midland, ADM, $62.30, is the world's largest corn processor. In addition to sourcing and processing oilseeds for food, feed and fuel, the company's AG services and oilseeds business also sources and processes grains. ADM has approximately 320 food processing facilities in over 200 countries and generates over $64 billion in yearly sales. Owner of numerous big ethanol plants in the U.S. Other fast-growing niches include alternative proteins, renewable energy, and pet feeds. In July, it bought the largest producer of plant-based proteins in Southern Europe, and in August, it partnered with Marathon Petroleum, MPC, to develop renewable diesel fuel. Number 5. Becton, Dickinson & Company. Becton Dickinson, BDX, $245.25, creates, produces, and distributes medical products. BD Medical, the company's main division, focuses on medicine delivery. BD Life Sciences offers diagnostic instruments and BD interventional supplies for urology and critical care. The company's annual sales exceed $17.1 billion. Becton Dickinson dominates practically every significant medical supply category. Annually, it services and supplies approximately 40 billion medical devices. New products like a COVID/flu assay that identifies antigens from nasal swabs and delivers a digital readout on its BD Veritaire device are expected to drive future growth. Number 4. Aflac. Aflac is number 1 in the US for supplemental health and life insurance. Aflac, $53.32. The corporation compensates its covered members for medical expenses. AFL also has a major presence in Japan, where it covers 1 in every 4 households with cancer and medical insurance. Over the last decade, Aflac has grown its EPS by 16% and its dividend by 8%. Recently, the corporation has outperformed analysts' expectations for 18 straight quarters. Aflac's revenues increased 8% year-over-year in the first half of 2021, but adjusted EPS increased by roughly 25% due to lower-than-expected benefit ratios and higher net investment gains. Aflac has a superior rating for financial strength, and it has $146.7 billion in cash and investments. Number 3. Franklin Resources. As one of the world's leading investment management businesses, Franklin Resources, BEN, $30.44, manages over $1.55 trillion in assets worldwide. Last year, Franklin Templeton acquired Legg Mason for $4.5 billion, more than doubling its assets. Less exposure to volatile asset classes and a more balanced institutional/retail customer mix are all benefits of the Legg Mason merger. Investors' preference for index funds has reduced Franklin's profit margins as an active fund manager. Alternative asset products acquired from Legg Mason are helping to reverse this trend, and fund inflows have increased significantly since the acquisition. For the June quarter, net fund flows to SRI set new highs. Approximately $3.1 billion went into alternative assets and $2.1 billion into fixed income. Number 2. Consolidated Edison. Consolidated Edison, ED, $74.61, delivers electricity, natural gas, and steam. Customers in Manhattan, the Bronx, and Queens receive electricity, while those in Manhattan also receive natural gas and steam. Consolidated Edison has $63 billion in assets and revenues of $12 billion. Consolidated Edison's growth rate has lagged other utility equities due to the maturity of its East Coast markets. Annual revenue growth has been less than 1%, EBITDA growth has been 5%, and EPS has been flat for the last 5 years. Analysts expect the company's EPS will expand by 3.5% annually over the next 3 to 5 years, compared to 6% for other utilities. Number 1. International Business Machines. IBM, $142.36, wants to reverse nearly a decade of sales declines by focusing on software and cloud services. Cloud-related services have been the company's fastest-growing area since it acquired Red Hat in 2019. IBM's June quarter results reflect progress toward its aims. Revenues increased 3% to $18.7 billion, exceeding analysts' expectations of $18.3 billion. IBM also announced adjusted EPS of $2.33, versus a consensus estimate of $2.29. Notable were double-digit improvements in Big Blue's cloud division. In 2021, the company expects sales to climb by 10% to 12%. IBM is in the midst of spinning off its $19 billion managed infrastructure subsidiary, KYNDRYL, to focus on its cloud business. IBM forecasts steady mid-single-digit sales growth after this spin-off. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.